There's a lot we don't know about what's happened overnight, but this adding to a host of geopolitical tensions of late.
Yeah.
In a situation like this, for investors, with your experience, what are you watching for? We need to establish more of the facts on the ground, I'm sure, but what catches your eye?
The key question, I think, is very much what the markets are focused on, and that is, what are the implications of this for oil supply? That really seems to be front and center. And the baseline, as the oil market's suggesting this morning, is that the disruptions are limited to physical oil supply. But the problem with geopolitical challenges is you've got to think hard about what are the tail risks. You know, what could happen that's different than that baseline? And then you move from concerns in the oil market to broader concerns about the economy and, frankly, the uncertainty associated with this. Might this thing escalate? If it does, what does that look like?
Okay, I mean, and sticking in the moment, if we are seeing the Iranians downplaying what has happened overnight, if that tells us anything about their reaction function around the Straits of Hormuz, that's really what markets need to know.
And if it does, then I would say that's extremely good news. And the reality of geopolitical challenges that we saw when we looked really carefully at the data is that markets tend to initially overreact. And I think it's precisely what we're alluding to here. That overreaction reflects that uncertainty premium when it first erupts. But typically, these events end up being less disruptive than we fear they might be.
Nathan, in about 24 hours' time, there is going to be a vote in the U.S. House, $95 billion of national security that targets Iran, Russia, China, defense spending, aid, etc. What do you make of that? How much of a difference does that aid package make? This is the first time we've seen all of these geopolitical issues wrapped into one with bipartisan support.
Yeah, I think that aid, that support is just absolutely critical. It's essential for Israel. It's essential as well for Ukraine. This is the United States asserting its role as the leading geopolitical, military, economic power in the world. And on the one hand, is there a cost associated with it? Absolutely. But I think it's a reflection of the U.S. role and our responsibility in the world to try to ensure that the world is as peaceful as it possibly can be. You know, at the moment, peaceful, and it doesn't sound like a very good description of where we are. But I think that that's the aspiration, and I think that's what we're hoping for with this aid.
At the same time this week, as these negotiations have been happening in Congress, you also have the IMF and World Bank spring meetings over in D.C. Kristalina Georgieva, the managing director over at the IMF, saying very crucially she's expecting those rate cuts to get pushed back, but ultimately to show up for the United States. To what extent can the U.S. consumer story hold up the global economy?
The U.S. consumer has been exceptional. The resilience we've seen over the last couple of years has been, and I need to use superlatives, remarkable. And when I look at the underlying fundamentals of the U.S. household sector, I continue to be quite encouraged. U.S. household balance sheets are strong. Wage growth is solid. Now, a footnote to that is we are seeing some strains amongst the lower income households. And if there's a place where there may be some cracks emerging, it may be there. But all in all, my sense is the U.S. consumer is far from tapped out.
But they are dealing with a lot of inflation, and potentially geopolitical events are going to make that inflationary story more difficult. Good morning, Nathan. How should we think about that intersection, about how geopolitics is going to impact the inflationary story? And should we be expecting, is your assessment, and you've done a lot of work on this in the report, that we are going to a period of heightened geopolitical tension where we're going to see more events, and therefore the inflationary impact could be even greater, both in the short term and the longer term sort of supply side knock-on?
we do look fairly closely at this issue of whether geopolitical risks and pressures are becoming more intense than they were previously. And on the one hand, we see these kinds of near-term geopolitical pressures in Ukraine and the Middle East, but there are also big structural developments that are geopolitical in nature, like the rise of China, a new great power in the world. And when you have new great powers rise, that's often been a source of ongoing geopolitical pressures. So we certainly see that potential. Now, thus far, when we look at the data, we don't really see a lot of evidence that the level of geopolitical pressures is elevated relative to the last 100 years. And you think about the last 100 years, you had the Cold War and the World Wars, and you had the War on Terror. There's been a lot of geopolitical pressure. But, the current decade has been somewhat elevated compared to the previous decade.
Right. And your analysis is quite clear. It takes you back to sort of the 2000s, the War on Terror, rather than back to anything.
Then.
Right. And it was elevated there, but we're not even, on your analysis, not back as high as that. So, I mean, even in your recent report, Nathan, you've got a guest essay from Ambassador Dennis Ross, really interesting. But even there, saying, rarely has the world seemed more unstable. Why does it feel that way to people and investors?
It certainly does. I think part of that is our memories are not infinitely long. And I think there are a lot of investors who don't remember the Cold War and even 9/11 and the War on Terror in that period. And we have been through a period of where it's been more quiet. But then in addition, I think there are some major seismic shifts that are occurring. The rise of China, which I mentioned, the rise of populist voices in politics in many countries, and even, I think, a really interesting geopolitical development that could have huge implications is the rise of renewables. It's going to shift the role of commodities that we see. So we haven't seen it yet, but I think maybe people are picking up that there are some pressures and developments in the global economy that could yet lead to meaningful shifts and perhaps even increases in geopolitical shocks and tensions.
In just a moment, I want to pivot and talk a little bit about how central banks are going to be responding to this. We've got some sound from Klaus Knott and from John Williams. Just picking up very briefly on that last point you made, oil no longer the transmission mechanism of geopolitical tension into the economy. What will become the transmission mechanism?
We struggled with this issue, and my sense it's likely to be something. Maybe in a world where we're trying to decarbonize, maybe it becomes copper. From time to time in geopolitical standoffs, it's rare earth metals. But it could also be other things, like maybe it becomes access to data. It's an open issue. But even without oil, my instinct is that we'll find new mechanisms of geopolitical confrontation.
But maybe pivoting away from that. Okay, let's turn our attention to what's happening with the central bank story and kind of come at this from a different angle, particularly the inflationary angle. Sit tight for a minute. John Williams was speaking yesterday. Klaus Knott was speaking yesterday. Very different kind of opinions being vocalized on either side of the Atlantic. Let's take a quick listen.
It's not my baseline. My expectation right now is that interest rates are in a good place, and eventually, at some point, would want to lower interest rates as the economy really gets to the 2% inflation that we're headed towards. If the data are telling us that we would need higher interest rates to achieve our goals, then we would obviously want to do that. So it's not my base case.
Monetary policy always takes place in a global context, but at the same time, we're not the 13th federal district. We have our own monetary policy, we have our own set of outlooks, economic outlook, inflation outlook, and as Christine already alluded to, some of the fundamental drivers of inflation have developed quite differently in the US than in the euro area.
Nathan, how far can the ECB and the Fed diverge?
This is a question that markets are wrestling with in real time. And it's striking that on the way up, I think there was remarkable synchronization during the hiking cycle. And now we're at a place where some of the economic fundamentals are diverging. And specifically, it is distinctly our sense the U.S. inflation is looking somewhat more sticky than European inflation. And moreover, the U.S. economy is looking somewhat stronger than the European economy. So the macro context for some divergence with the ECB and probably the Bank of England cutting well in advance of the Fed and maybe cutting several times, I think there's a strong case, and I think that's what they were alluding to. However, we've also seen that these major central banks, I would argue, like to follow the Federal Reserve, that following Jay Powell and the Fed creates a context that smooths the communication of policy and helps build consensus on central bank boards. So it's going to be a very interesting interlude here to see how much divergence we get. It's an open issue. My sense is that bottom line, you can see maybe a couple of cuts before the Fed, but I'd say only a couple of cuts. It's going to get hard to really get into a cutting cycle if the Fed is holding.
When we're talking specifically about kind of the marriage of geopolitical risk and the monetary policy, a lot of it is so much baked into this commodity story, that commodity inflation, supply side shocks is what's going to be the game changer. But if we're talking about wartime, hasn't historically, and you mentioned this a little bit in your report, hasn't historically wartime been a tailwind to the U.S. economy? Could we see that reinflation story again, not from the supply side, but from the demand side?
You know, the reality is that the spending associated with, military operations does tend to be stimulative, at least for the country that's doing the spending. It's not necessary, and I think this is a key point, not necessarily stimulative for the rest of the world, even in that instance. And moreover, and I think this is the bigger point, is it's very costly, humanitarian-wise, but in terms of wealth and structures, and over time, it's a substantial reduction of wealth, even if it's an increase in near-term GDP.